Greetings. Today is Friday, November 15th, 2024. And in today's video, we're going to take a quick look at the latest data on inflation. We're also going to take a look at what the bond market suggests for inflation. But before we do that, we want to give you an update for contribution limits for your retirement plans for the new year. That data is on the screen. So as the year draws to a close, we encourage you to take out your pay stub, take a look at the data on the screen and see if you need to increase your contribution limits. In particular, I also want to make sure that we're calling attention to these odd catch-up contribution brackets. I have no idea why they did this, but for whatever reason, if you're between the ages of 50 and 59, or if you're 64 plus, you have one catch-up contribution limit. But if you're between the ages of 60 and 63, you have a different catch-up contribution limit. Again, please don't ask me to explain the rationale there because it surely doesn't make any sense to me. If you have any questions on any of this data, send us an email and be happy to see if we can't be of service. That said, let's take a look at inflation. So earlier this week, we got updated information on inflation. On the screen right now, we have CPI, or the Consumer Price Index. And in particular, what we want to highlight is the fact that the latest data set did tick a little higher. However, we are still at the moment below this 10-year average, which is represented by the red line. However, the Federal Reserve likes to look at core CPI as opposed to the straight CPI number. So let's look at core CPI. We have increased again. However, here we are still above this 10-year average. So this data suggests that the battle with inflation has not yet been completely won. And if you look at the 10-year yield, I think that data suggests the same thing. On this screen, here we have the green line is the federal funds rate. The blue line represents the 10-year yield. And what we've talked about in the monthly market monologue is that recently, since about September, the yield on the 10-year treasuries have started to come down. But when I shot the monthly market monologue, the yield had risen back up to that downsloping trend line. And what I said then is that if the yields break back through that level, that suggests that we might not get any more interest rate cuts. That's what's happened. Right now, we have the 10-year yield as of this morning is about 4.44, and we have the federal funds rate is slightly below that. So this data suggests that the battle for inflation has not been won completely, and we might not get any more interest rate cuts. That'll do it for today. If you have any questions, naturally feel free to reach out to me or any member of our team. For those of you that are not familiar with Hicks Associates Wealth Management, we serve clients as their chief investment officer, managing their portfolios in a proactive manner. In particular, our active management approach is designed to minimize drawdowns while still capturing upside momentum. Again, if you have any questions, feel free to reach out. Until next time, thanks for watching.